Bismillahirrahmanirrahim. Assalamualaikum to all. Thank you again, Atta, for inviting me and as well as the Islamic Finance at SG Group to be a part of this, inshallah, blissful gathering virtually. And as of today, I'm going to touch upon the nexus of responsible SRI, which is socially responsible investment and Sharia compliant investment screening. I know that the topic for today that is been announced by Ethis was more towards socially responsible investment in the light of Sharia, but my focus for this webinar will be more on understanding the different processes of the current different processes of Sharia screening practices as well as the socially responsible investment. Okay. For today, we are covering this, for today's discussion, we are covering 5 points, inshallah. First and foremost, I'll give a very brief background on how socially responsible investment started, as well as the Sharia investment screening started. Later on, we'll touch upon a very brief overview of how Sharia screening practices and processes is being done, and as well as the socially responsible screening practices and process. And afterwards, we're trying to find the similarities and differences between the current socially responsible investment screening as well as the Sharia investment screening. And lastly, we try to look upon the Sharia or the Maqasid Sharia framework and its relevance to the SRI modern framework and also the SDGs. Okay, to start off, we'll do an interactive session here. If I can call upon all the participants here in the group to log into this website and give me an overview of what to you is responsible investment. And it is a poll, so your poll result will be live, so we can discuss together. I'll just give a few minutes for you all to log into this poll and to give your thoughts on what to you is responsible investment. Okay, we are still waiting. Okay, so now the result has started coming in. So there's a few here. Some of us says that investment that has social benefit, investment according to Sharia, being moral in investment choice, sustainable ethical investment. It is an investment into products, services that minimize the negative and maximize the positive impact in the society, not damaging the environment, investing the halal way, investment that places profit as secondary importance, responsible investment, moral, ethical, human investment, fulfilling Allah stipulated requirement, and so on. Okay. Thank you very much for your response. Uh, Again, how we differ in our definition on what is responsible investment. Currently, the definition for responsible investment also differs from different portfolios and also from different fund managers. All of them has a different definition on what is for them responsible investment. But just for the rule of thumb, we can go by with this definition on what is responsible investment. Here, Cowton in his book in 1994 states that responsible investment is the exercise of ethical and social criteria. These ethical and social criteria can be faith-based, which is Islamic or Sharia and so on, in the selection and the management of investment portfolios. Just moving forward, just a moment. Moving forward, a brief background on what is responsible investment and Sharia screening and how it comes about. So over the past few years, major transformation have taken place in the area of investment decision making, which includes the Sharia screening as well as the socially responsible investment screening, which is the SRI, and also the ESG screening, which is environmental, social, and governance. The acronym of ESG is again environmental, social, and governance screening. However, the term SRI, the acronym for socially responsible investment, came about through Christian investors who seek to distance themselves from activities they viewed as sinful. The proponent of this movement was John Wesley, founder of the Methodist Church, and in one of his sermons named The Use of Money, he outlined that money should not be used to hurt one's neighbor. And this includes profiting through harmful lending as well as unfair business practices. He also mentioned about profiting through the sales of alcoholic beverages and also profiting from businesses that directly and indirectly contributing to hurting one's neighbor. In addition, in his sermon, he advised his followers to avoid industries that may pollute the rivers and streams, as well as industries that profited through bribery practices. And from this, and since that sermon, we can observe that SRI was only limited to individual investment screening decision. It was not structured. It has no foundation and it has no framework that is mainstream yet. However, it was not until the late 1960s during the Vietnam War, which we can observe on the left-hand side of the screen. During the period of Vietnam War, when the faith-based avoidance model, which is the one that is being founded by John Wesley, was evolved into a public offering of screen investment funds that has expanded to include broader ethical criteria. It was throughout this era that the modern SRI form is founded, which is around the same period as well when the first Islamic bank were established in the Muslim world. And during the, if I'm not mistaken, during in 1971, during the Vietnam War period, when most corporate profits are made from the war, on the human suffering of the war. The first modern SRI mutual funds called Pax World Club was founded by a group of Methodist clergy in the USA as a response for investors who wanted to distance themselves and distance their profits from the war. And as the SRI grew in influence and in size, the initial emphasis of only excluding certain sectors that they don't want to promote or support, this emphasis on exclusionary screening practices shifted towards a broader ESG consideration. And broader ESG consideration here, I mean consideration to the environment, how the investment will impact the environment, how the investment will impact the social circle, and how the investment is being governed. And while SRI was developing and taking its modern shape, a new method of financing called Islamic finance were being innovated in the other side of the world, and I already mentioned in 1975, whereby the first Islamic bank were established. But it was not until 3 years later, in 1995, when the first first ruling or the first fatwa is being issued by the International Islamic Fiqh Academy. And this fatwa is issued on a specific ruling, which is the ruling on common stocks trading of companies for which Muslim investors are allowed to be a part of. Then the focal emphasis of the first resolution or the first ruling is to avoid or to reinstate the prohibition of engagement in activities which violate the Sharia principles, especially the prohibition of buying shares of companies that are engaged in impermissible businesses in any degree of involvement, whether in full or in partial. It's only after a decade after the first resolution that this resolution is being revised in 2000. So another fatwa by some other prominent scholars was issued, as Islamic investors during that time find it difficult to adhere fully to the first resolution. This resulted into a more detailed Sharia screening methodology that we will discuss later on, which is include sector screening, financial ratio screenings, impure income screening, and to accommodate the needs and the challenges of the global financial world. Okay, moving forward, just an explanation, very brief explanation on how the Sharia screening process works. So for any Sharia company or for any company to be identified as Sharia compliant, it needs to go to these 3 sets of screening. Again, what is Sharia screening process? It is a set of Sharia screening process based on Sharia principles that is applied for investors to identify Sharia compliant company. And why do we need this screening process to be applied? Because companies nowadays that exist, according to the Sharia compliancy, are either one, companies whose business and financial operations are permissible, meaning that they don't have any Sharia issues, whether in their business and also in their financial operation. Secondly is companies whose businesses and financial operation are Sharia impermissible, meaning their business, the core business and financial operation has Sharia issues. And thirdly is the one that is usually common in today's age, which is companies which are involved in permissible businesses like supermarket and etc., with a degree of impermissible business and financial operation. Just as an example, we can take the supermarket that sell alcohol. In general, its primary business is Sharia compliant, but the alcohol sale will be a part of the revenue that need to be screened out when we do our Sharia screening process. Okay, moving forward, what is this 3 process? The first and foremost is the first set of screening that is applied to any company is the business screening, or we call it sector screening. We can also call it a qualitative screening, which screens the company's business sector to ensure that companies which operate within specific business areas that are prohibited in Sharia are excluded from the investment universe. Later on, after this business screening, they will also apply the financial screening, which has 4 categories to it: revenue compliance screening, leverage compliance screening, and liquidity compliance screening, and as well as interest compliance screening. For the revenue compliance, based on Sharia principle, we know that income earnings should only be through Sharia permissible means. Like we mentioned, we can't earn through alcoholic sales, alcoholic beverages sales, or tobacco sales and stuff like that. But since a fully Sharia compliant company is scarce in the market, and most do not operate entirely in a Sharia prescribed manner, Sharia scholars have allowed a small percentage of impermissible income, which is here, the revenue compliance 5%, if the core nature of the business is Sharia compliant. They base their judgment on this 5%, they base their judgment on a legal maxim, a qawaid fiqh, that says the majority has the ruling of the whole, or the majority counts. Moving forward, later on, secondly, for the leverage compliance and liquidity compliance, from a Sharia perspective, we know that all liquid assets, either cash or debt, must be traded at par. And consequently, because of this, a company which the majority of its assets comprise of cash or debt is to be traded, cannot be traded either above or below its book value. However, trading at par value in the current market condition is impractical due to the reality that the market price of shares tends to fluctuate, which result in the price not necessarily represent the book value of the cash and debts, but the forecasted cash flows or the expected price value. Therefore, one is unable to trade according to the par value of the company at the current market. And to relieve this issue, Sharia scholars place the 33% or the 50% threshold on the proportion of cash and receivable to the total assets, or to the market capital asset. And lastly, on the interest compliance, we know that dealing with riba is firmly prohibited, either by giving or receiving interest-based debts. And giving interest-based debts either through interest-based deposits or interest-based securities such as government or corporate bonds are all prohibited in Sharia. And again, due to public needs, Islamic scholars have defined a threshold signaling to which extent it is permissible. And here we mentioned is 33%. This threshold again acts to minimize the investment in interest-based deposit or securities, which also will reduce the income generated from riba. And lastly, the last process is dividend purification, which is income. Whichever income that is generated from prohibited means will be deducted from dividends paid, and that income itself or that amount itself will be donated to the charity. Okay, just an overview of what we have mentioned before. We can see from the 4 column here is the major mainstream indices of, or you can call it Islamic indices that have been provided by mainstream investment market. So the first column here, we have the Dow Jones Islamic Market Index, and the second column, S&P Sharia Index. The third column, Financial Times Stock Exchange Index, and lastly, Morgan Stanley Capital International Islamic Index Series. If I can bring your attention to the first 6 sector, we can see there is an agreement or a consensual agreement to exclude all of these 6 sector. And why is that so? In other words, we can say that when there is an explicit prohibition from our Sharia, which either in the Quran or in the Sunnah, we find that all scholars are in agreement of the prohibition of this sector. Whereby, however, if the prohibition is somehow is debatable, we can also see this is being reflected in the indices. There seems to be a minor difference if we look at it between them. The Sharia compliancy of arms and defense, as well as the hotel sectors. Additionally, there is also a variance on the types of advertising sector and the kinds of operation within the media sector, which are identified as Sharia compliant. With this, we can presume that Dow Jones Islamic Market Index and S&P Sharia Supervisory Board are the least tolerant amongst the others due to the strict restriction imposed. And undoubtedly, because of this restriction, it will also result in a lower number of investment universe for Dow Jones Islamic Index and also for S&P Islamic Index, compared when we compare to the other two. As for the financial screening, we have mentioned previously that the companies that exist nowadays according to Sharia compliancy are either threefold, and our main focus is to identify the companies which are involved in permissible business. However, there is a degree of impermissible business or financial operation. So to mitigate this issue, the Sharia people have devised these financial ratios that we observe here in the screen. One might ask, why does the screening criteria differ? One of the reasons is that each indexes will have their own Sharia advisory board. So therefore, variance in the screening criteria exists. And also one thing to note about this is that we can observe that there is a difference on the denominator on how it is being calculated. One is market value and another one is total asset. Okay, the differences of this denominator used for measuring the financial screening ratios, as for example, Dow Jones Islamic Market Index and S&P use market capitalization, while FTSE and MSCI use total asset as the screening resource divisor. While both used to evaluate companies' value, they represent a different notion. This is because total asset give us a sense of the size of the company in terms of the combined value of all assets, whereby the market capitalization reflects the total equity value of a company overall outstanding share on the price prevailing in the market. However, both ratios divisor will have their pros and cons. For example, the advocates of total assets will say that the total asset measurement is more suitable and appropriate. This is because as the companies are being fairly valued from the accounting standard capacity, that is which means that is autonomous and is not influenced by any external market sentiments or speculation. However, the market capitalization proponents or the other camp will argue that the total asset reflects only the historical value and not the actual economic value. In addition, the difference in accounting standard application on inventories, revenue recognition, and depreciation will also result in a variation value when we were to use total asset as the denominator. Hence, total asset for them, for the market capitalization people, they will say that total asset measurement will tend to be undervalue of the total worth of a company. And lastly, we can also observe the variances in the threshold. So some of them will say 5% here, and let's say this is 33%, this is 49%, and this is 50%. So on which basis do Sharia scholars base this number on. For the 5%, I think we already mentioned that the majority has the ruling of the whole. As for the 33%, some of them, or the majority of them, give an example of this 33% based on the hadith that is been narrated by Sa'ad bin Abdul Waqqas, which mention, if I'm not mistaken, or in meaning, it says that to donate one's wealth more than 1/3 is too much, is a lot. So they use this 1/3 as a guide for them when they are giving the standard for these compliance ratios. Okay, this is a very brief overview on how the Sharia screening process has been done. Firstly, they started with sector screening, then they go through the financial screening, and lastly, they go to income purification. Okay, moving on, we have touched upon how the Sharia screening procedures is being done. So now we go to the SRI screening strategies. Here, I'm going to use strategies because they do not have a set of process that all of them SRI, or that we can say ESG investment managers provide. They don't have a structured manual whereby it is the same throughout the industry. So the primary approaches for responsible investors, they can adopt or may divide it into direct engagement or indirect engagement. The direct engagement here enables responsible investors to objectively engage with companies through either voting or either dialogue with senior management. However, the indirect management here is mostly commonly practiced by responsible index providers, which can also be further categorized into positive screening and negative screening. So the difference between the green and the red one here is that for the red one here, it is more towards identifying what are the things that you don't want to be a part of the investment without considering the ESG practices. This is just a brief definition on the different strategies that is being used by the SRI indices providers. So the most important thing and the most practice out there, if I can give you an example, is negative exclusionary screening and also ESG screening. So what is negative exclusionary screening? Is the exclusion from a fund or a portfolio of a certain sector. So similarly to the Sharia screening, whereby they screen out sector, these strategies of negative exclusionary screening also screen out certain sectors or companies that they don't want to be a part of the investment portfolio. And the second most used is the ESG integration, which is the systematic and explicit inclusion by investment managers of environmental, social governance factors, meaning that when they want to come up with a portfolio, they take into consideration on how well these companies perform on their environmental duties and also on their social duties and also on their governance duties. This is just an overview on the SRI screening strategies market right now. We can observe, like I mentioned before, the one that has been mostly practiced is ESG integration and negative exclusionary screening. And mostly for negative exclusionary screening is mostly practiced in Europe, whereby ESG integration is mostly practiced in the US market. Okay, just a recap on how they do these stages, on how they come out with the SRI in companies indices. First and foremost, what they will do is they will take a sample of invited companies. So they will invite companies to, let's say, to be included in these indices. And first and foremost, what they do is they will screen out certain companies that they don't want to be a part of the portfolio, and this includes, for example, tobacco, weapons, and fossil fuels. Later on, with this set of companies that they have, they will arrange them in order to have a sense on which company practices the best in terms of ESG concerns. And later on, this company will go to a portfolio universe according to the market cap. Just an example of a different SRI indices that is currently available in the market: Dow Jones, S&P, FTSE, MSCI. We can observe from the first initial screening, which is to the sector screening, most of them actually agree on certain sector to be excluded in the business criteria. And moving forward also, this is just the example of the differences and on how it's been practiced. So in summary, different SRI approaches and strategies are devised to target and measure different types of ESG risks that are unique to each industry. But they all share a common goal of integrating social and ethical criteria into an investment decision process. However, there are some crucial issues regarding the SRI index and ESG rating here. One of them, if we have mentioned previously, there is a lack of unified framework which helps to identify industry that is harmful to the society and the environment. And unlike the Islamic framework, where the Quran and Sunnah and sound reasoning are relied upon, the SRI screening has no core substance that they would be relied on for guidance. For example, with the gambling and alcohol industry, let's go back to the alcohol and gambling industry here. Only 2 out of 4 of the indices or selected indices that shows to exclude the industry from their selected company universe. Therefore, there are discrepancy between different SRI indices on how they define what is unethical and what is harmful industry. Because of these differences and variance in the SRI market, the SRI purists will view that SRI that is being practiced nowadays by majority fund management corporation are being only commercially motivated, and this is the reality of the state of the market, as the core purpose of most corporation is to generate profit. Okay, this is another example on how they differ on the ESG criteria of different indices. Okay, as we mentioned before, also the notion of ethical responsible investment, from this graph or from this table, we can see that this ethical responsible investment is not only unique to Islam. The underlying values of this moral investment are also shared across different religious tradition. Okay, here we can see the X indicates consensual agreement to exclude this sector, and P indicates partial investment, meaning some of them might say it's okay and some of them might say it's not okay. So just a recap on what is responsible investment. Again, it started as a faith-based movement, and it's called a socially responsible investment. But later on, throughout the journey on the formation of SRI, it has multiple names. Some call it ESG, some call it SRI, some call it impact investment, some call it ethical investment, some call it sustainable investment, and so on. There's many names to it. And the different definition or the variance of definition, the reason for it is that different people might have a different definition and value on how they see which sector is harmful and which sector is unethical. And one of the reason also is the marketing strategy, because for attracting investors to invest in our portfolio and in a certain ESG portfolio, they need to make themselves stand out. So they might define what is SRI to them, maybe different from other SRI indices provider. And again, how is SRI screening is being conducted? We have covered that it is mostly practiced using 7 SRI strategies. And how it's being practiced, first and foremost, they do the exclusionary, say, like the Islamic screening practices, which is mostly exclusionary. And they also, on top of that, they have another screening criteria, which is to do a positive screening. Positive screening, again, what is positive screening is to find the best businesses that is observing the ESG concern or the environment concern, the social concern, and also the governance concerns. But what is the limitation of this SRI screening? We mentioned that it's random. There's no consensual agreement on what is prohibited or not prohibited, what is a harmful industry and what is the unethical industry, and as well as is mostly commercially motivated. Okay, now let us touch upon, we have observed from our previous several slides that we know that Sharia, not Sharia businesses, but Sharia compliant businesses and Sharia screening, they mainly focus on excluding certain sectors and excluding certain businesses that practice certain prohibited financial operations. But we observe also that there is no positive screening that is being practiced by the Islamic indices. So, but what is the Sharia standpoint on this positive screening, whereby to include other environment concerns, social responsibility concerns, and governance concerns, and not just to identify what is halal and what is haram. We can find this notion in Surah Al-Mu'minun, which says that ya ayyuhar rusulu kulu minat tayyibat wa'malu salihah inni bima ta'maluna alim, which translate to all messengers, consume of the tayyib. Tayyib here mean good things, which doesn't necessarily mean halal things, because some halal things might not be tayyib for you. And act righteously. Indeed, I for what you do am knowing. So here the ayah, if we were to ponder upon it, it gives an indication of the importance of your consumption before acting righteously. And the Prophet Sallallahu Alaihi Wasallam, peace be upon him, mentioned that one of the story is that a person who is traveling for a long period of time in a desert, and it is covered and he is almost dying, and he lifted up his hand towards the sky to pray and to seek God helps. The Prophet ﷺ mentioned here, and how can his prayers be accepted when his food is unlawful, his drink is unlawful, his clothes are unlawful, and his nourishment is unlawful. Here, going back to our prescription, which is it doesn't necessarily means that to have halal investment, it means that you are consuming your profit through what is tayyib for you. Moving on, this table here is just to have a very brief overview on how the similarities and the differences between the Sharia and SII screening pertaining to the business sector screening. So we can observe from the SRI here, most of this sector is being observed, which is the alcohol, weapons, narcotics, and so on. But the current Sharia screening practices, some certain sectors or certain business practices is not being observed while Sharia screening is being done. One of it is the animal testing, climate change, ozone depletion, subsistence, deforestation. So the current Sharia screening practices doesn't give any concern on whether the business, even though it's halal according to the standard, does it actually give a negative contribution to the climate change and so on. Here, an overview of the differences of the Sharia screening and the socially responsible screening. The key characteristic difference between Sharia screening and socially responsible screening is relatively minor. Okay, for Sharia screening and socially responsible screening shares a similar broad objective, okay, of human well-being betterment. However, this objective is driven by a universal ethical and moral obligation, but with some differences on how, with some differences on how they been sourced from. Again, the difference of this is because of the source of guidance, which leads to the other different approaches in the investment strategies. The first of the three different investment approach are the financial screening. We can observe that Sharia screening funds are not the Sharia screening, sorry, the SRI screening funds are able to choose debt bearing investment and also equity bearing investment freely, okay, freely, as long as the chosen stock adheres to ESG and SRI principles, whereby the freedom is, however, restricted in Sharia investment, as they will need to adhere to several financial ratios thresholds such as the 5%, 33%, 50% that we have discussed before. Secondly is the income purification process, again, which is a cleansing process that accounts for investment earnings that are generated from either interest income or from impermissible revenue sources, and these accounts are then donated to non-profit organizations and charities. And one interesting note is that to date, it is only Sharia screening where income purification is being practiced. And lastly, the third one and the final difference is the positive screening. Sharia, as I mentioned before, Sharia screening uses none of the consideration of SRI positive screening, okay, which is the best in class and so on and etc. This consideration includes, but not limited to, environmental degradation, social well-being and development, corruption, transparency, labor standards, as well as business ethics. Moving forward, again, what is responsible investment? From our discussion before, we can observe that different people or different indices, whether it's SRI or Sharia investment, they have a relatively different view on what is responsible investment, even though they are describing the same thing. So like an example, this picture and image itself, a group of scientists which is blinded trying to explain what they are touching, which is necessarily is an elephant here, is in essence is an elephant, and different scientists actually describe different parts of an elephant according to what they can understand. So to sum up, there is a great deal of similarities and differences, and a great deal of similarities between SRI and Sharia funds. This immense similarity may boil down to the reason that the SRI in history was driven by faith-based movement, and in similar manner, the Islamic investment funds are also guided by Sharia principles. Okay, moving forward, the last part of our discussion for today is Reimagining Sharia Screening and Maqasid Sharia Framework. And so how can, so the question here lies on how can Sharia screening be closer to its substance and be closer to the Maqasid. Maqasid here means the objective of Sharia, or the objective of the Islamic law. And to know, to understand, before we go further on to understanding what is the objective of law, of the objective of the Sharia, just a brief explanation here. in Islam, we believe that all creation has its purpose, and this is been emphasized in the Quran in Surah Ali Imran, verse 91, which states, الذين يذكرون الله قياما وقعودا وعلى جنوبهم ويتفكرون في خلق السماوات والأرض ربنا ما خلقت هذا باطلا. So we know that from this ayah we know that there's no there's reason to every creation. Okay, so we need to ask ourselves again while looking through the Quran, what is the purpose of our creation? And Allah has given us three purposes of creation. First and foremost is ibadah, which is servitude. And this is mentioned in Surah Zariyat, verse 56, which states, and I, Allah, created not the jinns and human except they should worship me alone. After understanding that, we also know that our purpose of creation is for Khilafah or vicegerents. And we can find this in Surah Al-Baqarah in verse 30, which mentioned, and remember when your Lord said to the angels, I am going to place Khilafah on this earth. And lastly is for development. We can find this thing in Surah Al-Hud, which mentioned, he is the one brought to you into being from the earth and has istamarakum and has asked you to develop and make you settle therein. The interesting part of this ayah for the Imran, if we were to analyze it closely, right? Allah has mentioned that we are created from this earth. Okay, so because of that, we have the responsibility to positively develop it. And this notion also is similar to the notion of why we somehow have a moral obligation towards our parents, because we actually come to being from them. Because of that, we also have the moral obligation towards our environment and earth, because we were in essence created from earth as well. And why Maqasid Sharia came about? So Maqasid Sharia, in very brief, came about to actually serve, to actually help or to minister the human being to achieve these three purpose of creation. Okay, so Maqasid al-Shariah. So how Maqasid Sharia comes about? Maqasid Sharia comes about from the induction of all the Sharia laws that is written in the Quran and the Hadith. So what the scholars did, that they looked through all these different rulings from the first bab of fiqh, let's say the Tahara, and until the last bab of fiqh, which is Ijtihad, and to actually try to find a realization on what are the key objective of these Sharia rulings. Okay, they found out that there are 5 initial objective of Sharia, but in essence, these 5 objective is to serve the human purpose of creation, which is ibadah, khilafah, and imran. Why? Because if only through Maqasid Sharia, only through Sharia, human can realize their overall potential of human well-being and its purpose. Okay, so this is just an example of how it has been the purpose of creation. Okay, ibadah, khilafah, and imara, which is taught by a tawhid in believing in one God, and this is a part of the Sharia on the purpose of Sharia, which is to observe, to safeguard and to promote the faith, moral values and standard, to promote and safeguard the posterity, the wealth, intellect, and life. Okay. However, these 5 pillars of Maqasid Sharia has a different degree to it. And it is divided into Daruriyah, which is the essential. Secondly, Hajiyah and Tahsiniyah. I'm not going to go in details with it. I don't think the time permits it. But in summary, what is daruriyah is what is fundamentally needed by every human being, which is the food and stuff like that. And hajia, what is hajia is the supplementary ruling for essential, which is, let's say, sale contract. You can go by without sales contract, but it's a need, but it's not an essence. And lastly is tahsinia, which is embellishment, which is interest concerning to refinement and perfection in people's daily custom and conduct at all level of human well-being. Moving forward, just to give a very brief example on how our Sharia have a very strong root for ESG. If this is just a few example on ESG concerns and what our prophetic tradition has mentioned. It's diverse. We can see it has several mention on climate change, has several mention on water use, and it also have several mention on pollution and waste control. Okay, and also it has also for social concerns as well. It has several mention of human rights, animal welfare, health and safety, and product liability. And lastly, the governance concern, it also have mentioned on corporate citizenship, philanthropy, corporate governance, business ethics, employee welfare and relation, and so on. So what I'm trying to say here is that even though that we find a lot of these Sharia principles, these ESG principles within our Sharia, it is sadly to say that we didn't find any of these being practiced in our Sharia screening in today's age. Okay, moving forward as well, the SDGs, which is the UN Sustainable Development Goals. I'm not going to go mention or to explain further on what is SDGs. I think it's already been covered previously by Ethis webinar in our previous webinar. But what I'm trying to mention here is that if you can have a look at it, right? Maqasid Sharia is diverse in its objective. It is diverse in its objective in sense that it covers not only the ESG concerns, but it also comprehensively covers the the SDGs concerns. So for an example, let us take the first 4 SDGs concern, which is no poverty, zero hunger, good well-being, and quality education. We can see that from poverty, for the life itself, we have a lot of mention of from our tradition or from our Sharia tradition that mention on the protection of life and so on. And moving forward here, we can also see that how Maqasid Sharia is related to the ESG. And a tick here means a direct relation, and a tick within a bracket means an indirect relation. Okay, to end the webinar, right? Just a food for thought for our current Sharia screening practices. Allah mentioned in Surah An-Nahl verse 90. He mentions that Inna Allah ya'muru bil adli wa ihsan wa ita'i zil qurba wa yanha 'anil fahsya'i wal munkar wal baghi ya'izukum la'allakum tadhakkarun. Indeed, Allah commands justice and ihsan, which is perfection and grace, as well as courtesy to close relatives. He forbids indecency, wickedness, and aggression, and he also instruct you, so perhaps you will be mindful. So in conclusion, having understood the worldview of and the Maqasid framework with their characteristic and relevance to the SRI and the SDGs, we can somehow deduce that the current Sharia screening practices is mostly towards the binary differences between halal and haram model, which in essence right now is not sufficient because the Islamic substance we have noticed from the Islamic tradition and also from the Maqasids, the Islamic substance and essence are hollowed out from the current model, and it is insufficient to help the humankind to realize the purpose of its creation with excellence. Moreover, it is also inadequate to safeguard the overall human well-being, and is also insufficient to elevate it to achieve the highest quality. So with this in mind, right, knowing that our the our counterparts, which is the conventional financial institution, they are doing their best to actually to provide the market to achieve the SDGs. But to help the private market to achieve the SDGs by giving them the ESG indices and stuff like that. And sadly, for our Sharia screening or the Sharia investment screening, there are currently no indices that are gearing towards SDGs realization by 2030. However, even though that there isn't any structured or mainstream indices of Sharia investment indices that provide ESG concerns in their Sharia screening practices, we, however, have several startups that actually try to converge the Sharia screening practices as well as the ESG screening practices. And we can find this, for example, the companies like Wahid Investment, as well as Ideal Ratings, and lastly also Ethis, whereby they not only focus on to find what is halal and what is haram in the structure, but also to go beyond the structure and to find what for the substance, and to go beyond and to impact, to positively impact the social, the environment, and also to observe the governance the best as they go. Okay, so that concludes my presentation for today. Hopefully, I wish that all of you here might have benefited somehow from this presentation. And if you have any questions, you can post it here.
Brother Zul, we have quite a few questions
Yes.
posted, so maybe we can start off with those.
Okay, so where can I start first? Which question can you say it here, Ataf, for me?
At the bottom of your screen, do you see the Q&A thing? Or
Yeah,
wait.
yeah, I see it. I can see the question, but I'm not sure which question should I address first.
Okay, maybe we can start with the first one.
Okay.
Yeah. So.
Okay, who mentioned these principles? I'm not sure what you mean by principles. Okay, if you mean about Sharia principles here means what is being subscribed or being prescribed by us through either Quran verses or through a hadith tradition. So what the scholars did is that they look through all the rulings of the Quran and all the rulings of the hadith, and they come out with these principles on Sharia principle in commercial dealings. Okay. And second question here is, could you please repeat that point on autonomy financial screening by Amani? I don't quite understand by your question. Maybe you can ask again here later. And the third question is, should the use of 1/3 as a basis of screening be considered? The hadith refer to the case of donation. Okay, this is true. Being a usul fiqh student, right? This basis somehow doesn't falls under any principles of jurisprudence way on attaining a certain criteria. However, this is just based on the ijtihad of the scholars to find what are the threshold that they can provide for as a guide for the Muslim investors. So they try their best to do qiyas, even though this qiyas some usul fiqh might say is qiyas mal farik, but this is one of their humble effort to actually give laxity for Muslim investors to at least invest in the capital market. Okay. Okay, a question by Anis. Are these training strategies used in combination or in silos? Okay, if for SRI screening strategies, okay, for SRI screening strategies, as I mentioned previously, it's been either being some indices might do it in silos and some might do it in combination. Some might do it negative screening as well as SDGs integration. Some of them might only do negative screening, and some of them might only do ESG integration screening. Okay. The question by Muhammad Yasir Khalid: does the Sharia screening or SRI screening presented follow certain school of fiqh or is common to all schools? Okay, in essence, for the Sharia screening methodology, not the threshold, but the methodology, right? Which is not the threshold of the ratios, but let's say financial screening and business screening. It is a part of all the school of fiqh, to my knowledge, to observe on which sector or which sector not to invest in. For an example, let's say if you have a money, you want to invest in a pork industry, in the pork industry market. I don't think that there is any differences in the fiqh mazhab to say that maybe this is allowed in certain school of fiqh and not and is permissible in certain school of fiqh and prohibited in certain school of fiqh. As for SRI, okay, SRI as a principle, it is mentioned in our Sharia, and we already mentioned the ESG, right? I've given to you a list of ESG concerns and what our hadith prophetic tradition entails. Okay, so regardless of the fiqh school of fiqh, it is deeply rooted in our Sharia. Moving on, green sukuk in Malaysia falls under SRI sukuk framework and guidelines. Do they follow the Maqasid Sharia as for the SRI? Okay, for green sukuk, to my knowledge, that green sukuk they don't necessarily follow the SRI sukuk framework, but the SRI or the SDG sukuk or the SRI sukuk follows the SRI sukuk framework. What green sukuk in Malaysia follows is actually the Green Bond Initiative framework, if I'm not mistaken. So in essence, if this green sukuk or the proceeds of this sukuk is being used to mitigate, let's say, environmental concerns or to help for the betterment of the society and stuff like that, it's a part of the Maqasid al-Shariah. Okay, moving on, what is the reason for Sharia screening being behind in screening certain issues like mentioned in the presentation? Sorry. Maqasid is supposedly being observed as when needs come. What is the reason of Sharia screening being behind in screening certain issues like this? I'm sorry, Muhammad Yasir Khalil. I don't quite understand your question. Maybe you can elaborate more. A question by Mr. Anis here. Can we say responsible investing, SRI investing, ESG is taken care by Sharia compliant investment? We can't say that from our observation before. The current context on how Sharia compliant investment or screening is being conducted, they mostly screen out activities for which they believe is Sharia non-compliant. We already mentioned that in detail, the tobacco industry and stuff like that, and so on. So they don't actually look upon, let's say, we have a set of a universe of Sharia compliant investment, right? They don't actually look upon which of these Sharia compliant investment is best in practicing the environmental issues, or is the best in practicing the social issues, which is best in giving the most impactful investment to the society and stuff like that, and so on. Okay, and another question by Mariam binti Saim. Today, the USD currency plays a major part in every business and investment, which is known as petrodollar. Yes, the petrodollar in any US dollar paid to other countries, nations, or all. Since the dollar is a global currency, all international transactions are priced in dollars. Okay, in your opinion, what will happen to investment in USD currency is being replaced by Israeli shekels? What are the changes, the transformation to business investment may happen? Okay, this question is very good. Okay, but I guess it needs another webinar to address this in detail. But as we can see right now, right, because of the factor that most investment is being done through USD, the need of the USD, the how can I say it, the US market, or the whole global financial industry is heavily relying upon on how well the US market is being conducted. But recently, if we notice that even though that we buy or we do our transaction in USD, right, there's another factor that also affect the global market, which is the supply of that commodity. Let's say, even though the commodity is being traded by the US market, the commodity itself doesn't necessarily comes from the US market. And we can see from this recent development of the coronavirus on how well we not only need the US market to do well, but also the China market here. So in summary, any industry or any government that have the majority of these factors, either in currency or in supply and stuff like that, they will have the full control or the optimal control of the financial industry. Okay, moving forward, can you please let me know in regards to interest-bearing accounts and insurance policies taken by businesses, or in case of Ethis with property developer? I think this thing you can ask directly to Ethis. I'm not sure regarding that because I'm not involved in Ethis practices. Okay, the funds deployed by banks used to finance Sharia compliance. Funds deployed by bank used to finance Sharia compliant activities. Yes, some of them may, depending on what type of banks are they. Is it Islamic banks or is it conventional banks? Okay, are there any investment that specifically exclude investment in illegally occupied Palestine? Okay, this is one of the things that we need to talk about as well, because we mentioned previously that SRI strategies, right? It started off as a faith-based institution to distance oneself from the war that is been happening in Vietnam, and also the appetite movement. So these are some of the concerns that I believe that the current Sharia screening practices should practice or should observe. They should observe whether this investment they put into a company, whether this company have any association or is related to any is related to a company that is negatively impacting the Palestinian causes. Okay. Moving on, by Muhammad Samija, we have some standard mentioned by scholars which give 33% of interest, but where is the source of that? I didn't get that anywhere. Okay, for this, they derive their justification by a hadith that is narrated by, if I'm not mistaken, by Sa'id bin Abdul Waqqas, whereby it mentioned on donation, okay, on donation, but not on interest. So this is just a qiyas or analogy that is been done by the scholars, or the ijtihad that is been done by the scholars. So the hadith mentioned on 1/3 of the wealth being too much, or the one third of your wealth when you want to donate before you pass away is a lot. Okay, by Fatin Fatah Salam, yeah, you mentioned that one of the SII screening strategy is through direct engagement, involves voting and dialogue. How does the voting part work, please? Okay, so in I'm not sure in our part of the world, but let's say in the US, whereby the people are much more vibrant and they have this somehow relatively freedom of speech. So either by dialogue or either by voting, meaning that let's say I have a share, I have a huge percentage of share in a certain company. Okay, if I have that certain majority of a share in a certain company, I also can influence the company direction in the future. And this is what they mean by voting. So I vote in a shareholder meeting kind of environment. I vote for this company to perform a certain businesses, or to exclude certain businesses and stuff like that. And through dialogue is just a dialogue or with the CEOs of the company and the board managers of the company and so on. By Shamil Shamun Salam, we are in the process of setting up in Singapore and Indonesia. How can we contact you for further advertise and consultation? Okay, you may contact Ethis and also Ataf here to get my contact details, Mr. Shamil. Okay, how do you see WACF as a potential practice as SRI? This has been discussed in length by majority of researchers of Islamic finance. There is this concept called blended finance. Okay, blended finance, or we call it blended finance, whereby they converge Islamic social finance, which is the waqf, sadaqah, zakat, for the betterment of the social responsibility investment. For example, let's say Ethis, okay, Ethis is now is involved in investing in okay, Ethis is currently in how to answer this again. Okay, for example, Ethis, they are actively involved in investing in properties in the Indonesian market, right? So for any investors, when they invest in this kind of situation, they're bound to be credit risk for them. So by integrating blended finance, this credit risk can be mitigated through waqf funds. So this waqf fund, any proceeds of this waqf fund can be covered for any risk involved in these practices and stuff like that. In detail, you can give me a call. I can answer to you in detail. Okay, does the screening in the indices look into the method of contracts such as sukuk, musyarakah, mudarabah, etc.? Again, if indices is concerned, they don't look through the contract itself, but they only look through the business sector and how the finances operation is being conducted. Okay, so for example, let's say they look through all the method of contracts, right? So one of the example is that we know that the interest-bearing income ratios, right, is a debt instrument. Okay, so if we were to use sukuk as a replacement, it won't fall into the debt-bearing ratio, but it will falls into the liquidity ratios and stuff like that, receivable ratios. That's just a minor difference. By BB Jan Muhammad Ayub, I think Professor BB Jan Muhammad Ayub, Salam, Brother Zul Hakim. Thanks for the informative sharing. In terms of volume, just as an estimate, what is the percentage of Islamic finance investment compared to conventional finance investment globally. Considering now more concerns with governance, social and environmental practice. Okay, for Professor Bibijan, I don't have the current number right now, but please leave to me your email. You can email me at again it's zhakim at hbku.edu.qa. So please email me your information and I will hopefully reply to you back on what is the current percentage of Islamic finance investment compared to conventional finance investment globally. For Ms. Rahal Ahmad, can the Sharia screening be employed to channel investment to Islamic microfinance industry to Islamic MIVs? Is there any the need to develop a framework that looks at the specific characteristics? Again, uh, uh, the same Sharia screening practices that is being done for indices can also be done for individual investment decision, either is microfinance or any type of kind of finance. The only thing that we need to have if we were to observe the Maqasid is to observe the impact on this microfinance will have in terms of the environment, in terms of the social, and also in terms of the governance. Okay, the last three question for Muhammad Samija. I meant generally, how does interest-bearing accounts and insurance policies affect us Muslim making responsible investment in stocks? Okay, so naturally, right? So if let's say I were to invest in companies that have interest-bearing accounts through the process or the Sharia screening process, they will exclude or they will limit a threshold. So let's say a company that has a 20% of interest-bearing account, it shows that the Muslim also, or as an individual Muslim, you are a part of that 20%, meaning that you own a 20%, or your income is a part 20% of your total income later on will be from the interest bearing accounts. But uh, you don't need to worry about it, because we have the other screening criteria process, which is the purification methods. So what does the purification methods do is they will exclude all incomes earning that comes from this kind of means, which is the interest bearing account and stuff like that. Okay, the last two is merely being Sharia compliant sufficient to meet the objective of Sharia. The straight answer will be no. Okay, because we have observed Sharia compliant as of how it's being practiced. It's just a binary differences or binary objective of identifying what is halal and what is haram, but it doesn't define the different degree of halal to shows that okay, this business is halal, but how tayyib it is, on how well it is observing or how well this business is helping the environment, how well is this business is protecting the social concerns and stuff like that. Okay, and last but not least, what roles does fintech and digitization could play in enhancing compliance SRI? Okay, fintech again holds a very big influence. Okay, one of it is we can say is that with fintech, many more people can be involved in the market. For example, I'm not sure how many of you here or in our age right now, from the range from 20 to let's say 40s, actually plays in the stock market. Okay, one of the reason is that they require a very huge minimum sum before you can actually play in the market. But what fintech can help is to minimize this entrance fee that you can pay. So I can invest or I can be a part of this market even though I'm only investing, let's say $100 per month. or $200 per month, comparing by the way how it was being structured previously. You need to invest a huge amount before you can actually play in this market. Okay, and I think that is the last question. Okay, if you have any further clarification, or I didn't manage to answer your question in details, please email me at chakim@hbku.edu.qa. Okay. Wassalamualaikum warahmatullahi taala wabarakatuh.
Assalam. Thank you, Brother Zul. So with this, I think we can call off the webinar. Very insightful session. And for our users, if they have any unanswered questions, they can reach out to us at support@ethis.co. The email address is there in the chat box. You can reach out to Brother Zul if you want any specific answers on this specific topic. We will be sharing the recorded session and the slides with you later on. Also visit our platform ethis.co and to know more on impact investments and impactful charity options. With that, stay safe, stay home, so wash your hands, and Assalamu alaikum.
Thank you very much, bro.
Right.